OSCR Health has caught the attention of investors due to its rapid growth, and some investors think the stock could 5 or even 10x in value. So let's take a closer look. At the latest share price of $19, OSCR Health has a current market cap around $5.8 billion. The company has over $3 billion of cash and investments, but most of it is needed for insurance operations, so I put the true enterprise value at $5.6 billion. Meanwhile, the company has reported $10 billion of revenue over the last 12 months, $123 million of net income and $508 million of adjusted ebitda. So the stock is trading at 47 times earnings and 11 times ebitda. OSCR Health is attempting to disrupt health insurance in the US with a technology-driven approach that focuses on individuals and small businesses. The rise of freelancing and the gig economy has created a large pool of individuals that would like insurance, and OSCR has been riding this trend successfully. Since December 2020, members have grown from 400,000 to over 2 million, and annual revenues have increased over 2,000%. Last year, the company posted its first ever GAAP profit. Meanwhile, CEO Mark Bertolini laid out a confident outlook for the company's next stage. He intends to grow revenues at least 20% a year for the next 3 years and get to an operating margin of 5%. That equates to 2027 revenues of $15.9 billion, with roughly $800 million of operating income. Put a conservative 14 times multiple on that figure and you get a market cap of $11.1 billion, which is roughly a double from here. And so the bull case for OSCR Health is actually quite simple. If the company continues to perform and meet its targets, the stock has clear upside ahead. However, there is a catch that investors need to consider. Around 97% of OSCR's revenue comes from healthcare plans sold under the Affordable Care Act, which is currently in jeopardy under the current Republican government. Although a full repeal of Obamacare is unlikely, Trump's government is taking steps that will limit its use. Subsidies are likely to end in 2026, and the Washington Post estimates 17 million Americans could lose healthcare coverage. Many of those Americans will be customers of OSCR, so you can see that the company is clearly going to experience some significant pressures next year. And yet the case for OSCR Health still isn't cut and dried, because the company's targets already bake in the end of those subsidies. For Bertolini, the company can continue to thrive, and OSCR may yet benefit from a separate initiative working its way through the government called the Individual Coverage HRA, or ICHRA, which allows individuals to select their own insurance with monthly contributions from employers. Ultimately, this is a highly promising insurance business with a lot of moving parts. Rapid growth and a high net promoter score suggest the company is on the right track and worth watching, but even management isn't sure exactly what will happen next year. That means there may be better chances to buy the stock. But these are my personal opinions, not financial advice, and I currently hold no position in OSCR Health. For more investing videos, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.